Evergrand is somewhat new to me in terms of its challenges. So I want to just cover as much as I can as quickly on this topic, but really get feedback from others who are engaged here. Second. So let's get started. So global growth has actually been quite strong overall, and the light, the top blue line is the emerging economies. You can see the sharp move there. The next line below in the lighter blue grayish area is the world economy. And then you can see the advanced economies in red in the US, which, you know, everyone's had a big rebound. There is some hooking down from the emerging economies and the world. A lot of that's due to China slowing down. And then the other big issue that people are focused on is the inflation expectations. And again, you see the world in yellow, advanced economies in red, and emerging economies in blue. And there has been a pickup in inflation. I think the ARS expectations was always that inflation would be transitory. We still feel that way, but we think it's going to be persistent longer than we had planned, maybe another quarter or two, and maybe even a little bit longer, but we do think inflation will come back down. And a lot of that's due to productivity, but let's just take a look at Evergrande and by the numbers. So it was once China's #2 property developer. It had assets of around $330 billion. The stock is down about 90% since 17 and about 85% this year. It has been a bouncy stock, to say the least. But just to put some of this into perspective, they serve third and fourth tier cities in China. It employs quite a few people directly and indirectly. Over 3.8 million people work on the development of their projects. And a lot of people have put money down on deposits for them on properties that have yet to be built. Unfortunately, the way the money was used is going to be called into question, as they have a lot of wealth investments in there that people are making investments to get big returns that are suspect to whether that's going to be paid out on. There's also the question of what do they do with as big an entity? And just to give you a little bit of perspective on the property market in China, it's now about $11 trillion of debt in the market. It's about 80% of GDP today, and in 2004 it was less than 30% of GDP. So real estate debt is certainly risen quite a bit. Chinese bank loans were $5 trillion roughly in 2008. They're now 30 trillion today. M2 in 2008 was 6 trillion for China. It's now 36 trillion. So Evergrande in and of itself is not a major problem in terms of the overall scale of debt and things like that. But as we learned from Lehman and some other incidents in the past, it doesn't take much to have something snowball that you think initially is not that big a deal. But their bonds are selling for about 25 cents on the dollar now, and they have a lot of unfinished properties. So this is going to be something that has to play out over time. My suspicion is that it is not a Lehman moment, that it's maybe even not a long-term capital as people are talking about, but maybe it's going to be more like the government just steps in, does a restructuring, and breaks up the company and moves their properties into other areas. This is a company that got way over its skis, in the sense that they were just kind of way over indebted, and then they started moving into other areas of businesses. So they started getting into electric vehicles, theme parks, bottled water, soccer teams, just to name a few. And when you're doing that on a highly indebted setup, it's not the best situation. So the other thing to keep in mind, and where this does have some implications, mainly inside China, is that home ownership now in China accounts for more than half of the household balance sheet, which is much higher than it is in the US. So I think this is something that will be an internal problem. It'll likely be controlled, but it will just be more of the theme around uncertainty about investment strategies in China. So our take on this is be cautious if you're playing in this market. This is where opportunities come, but there's a lot of movement in the Chinese market right now. Moving to global debt, the Institute of International Finance did a pandemic update last week, and just to put, this picture into a little bit more perspective, global debt is at the end of the quarter was 296 trillion versus 271 a year before. A lot of that is government debt, non-financial corporate debt, which the government debt was due to the financial crisis and trying to support the economy. The non-financial corporate debt was really a reflection of taking advantage of the low interest rates that exist. Financial corporate debt is about 70 trillion, and consumer debt, which is actually in the US, is getting, their balance sheets are getting repaired. But just to put it in more perspective, global debt to GDP declined over the quarter from March to June, but is still much higher than the pre-pandemic level, which was 333%. Global debt to GDP, again, was 302.10, so it has been steadily climbing. So in short, we took a debt crisis back in 2008 and used debt to solve a debt crisis, which is going to create more of a debt crisis at some point in the future. So we still have to worry about when the bill comes due. So, the great financial crisis with debt was debt driven, and global debt has risen by over a third. The drivers are really central banks. China's played a big role in corporations, consumers in some economies, but in the US, and for example, the balance sheets for many have improved considerably. Interest rates continue to be suppressed, which continue to allow for the buildup of debt without immediate concerns in the market. But there was a great article in the FT by Gillian Tett on Friday, where she talked about the market reaction to this growing debt, and she referred to the social science concept introduced by Pierre Bourdieu, and it's really about when you have issues right in front of you and you see them evolving, they tend not to create the panic. And we've had this steady debt buildup for some time. And what's ironic is it's coming out of a debt crisis. So where does this leave us? I think, Mark, you asked about Ed Yardeni. One of the comments that Ed would have on this is that he views what's going on here is if you want to see how this might play out around the world, our debt problem, look to Japan, which has been having suppressed interest rates, growing debt, slowing growth for some time. I think there's an issue there. The other thing to keep in mind is, just for perspective, policy rates then and now, and this shows you for the US, the Euro area, Japan, the UK, and Canada, the policy rates back in 5, 6, and 7, and 8, and what they look like today. And just to put it in perspective, if you added 90 trillion of debt and you move back to the 5 or 6% level from where we are today, you can do the math. That's going to add significant interest costs to the global economy. So we expect that central banks will work hard to keep rates low. We think that you'll see tapering coming from the Fed starting later this year and trying to end sometime in the end of the second, beginning of the third quarter next year, so that they will have time, if there's other problems that arise between now and then, other crises that have to be addressed, they'll be in a better position to raise rates if inflation's out of control, or take other actions if it's not. Global interest rates are also interesting. So ISI puts out a piece pretty regularly from Ed Hyman, where he talks about global short rates right now at about a 0.88% level. And then if you just look at this going back to 06, 07, we are really repressed. The blue line on the bottom is Japan, and that's kind of where the world has been heading to. And this is an area that I think bears watching, but tapering can occur and rates not move up for some time. And even if we start the tapering process at the end of this year, we are still going to be adding probably between 90 or $105 billion a month in the US, and scaling that down at about 15 billion a period to take it to taper all the way down. So That's a lot of stimulus that's still going into the system. The other thing to point out is the lag effect of lowering interest rates by central banks is usually a 2-year period, 18 months to 2 years. So you could see stimulus flowing through the system for an extended period of time, even though tapering is going to start, and people are going to get confused by that. But this is still going to be a highly accommodative economy, both in the US and globally. So we still think the 6 transformations we talked about are the ones to follow: the monetary and fiscal, political, geopolitical, social, societal, perhaps the most important being the digital, and then the climate and education ones are still going to play out over some time. We have massive liquidity around the world, which is having people take on excessive risk, leading to some situations like Evergrand. But as long as we keep rates low, a lot of the debt will be manageable. But at some point, there will be a bill coming due. And how the world resolves that is going to be quite interesting. Do we do some, like a debt jubilee, or do we just restructure debt? I think it's going to be a combination of things depending on the different economies. The Federal Reserve will begin tapering, but not tighten policy meaningfully anytime soon. Again, just because they start tapering, we're still going to be very expansive in our policy there. Corporations, consumers, and governments are all spending to improve productivity, and we think that is going to be the big offset. It's harder to measure, so people will be a little thrown off by that. But we continue to have a positive outlook for corporate earnings and profits, but quite frankly, the benefits are not going to be shared equally because certain companies can pass on their higher input costs and in form of higher prices, others can't. And that's going to be what we think will be a big determinant of the differentiation. We think equity investing remains the best game in town, both public and private. We think China is, there's 2 camps on China. This is a great opportunity, or it's getting uninvestable. We think it's just getting more difficult to invest and requires greater selectivity, but it also will not be for the faint of heart. And you should risk adjust your investments there accordingly to government intervention that will remain quite high. Inflation is running hotter and longer than we anticipated, but we still believe it's going to be transitory due to the productivity increases. We suggest people stay invested, use dips to add to positions. But as I said for a while now, this is a time to be cautious but opportunistic as we move forward. So Mark, we'll stop and take questions, open up to discussion. And I'd love to hear from people on Asia about their thoughts on how this is playing out there.
Yeah, questions, comments?
That was terrific, Stephen. Really great. I had seen somewhere that kind of general exposure to Evergrand from outside is actually not that great. So I'm assuming that a lot of the reaction yesterday was pretty much more psychological rather than anything else. Does that match up with what you've seen as well?
Yeah, I think it's we had been in a market that had been range bound, both on interest rates and the equity markets in the US for some time. But quite frankly, this isn't a surprise in China. The Chinese market's down almost 30% this year. So it does give you a sense that this is a more contained kind of setup. But there's also an element that the Chinese government wants to take excesses out. And what they're doing is they're dealing with the excesses and letting people take the pain for the greater good. And this is where their common prosperity push is really needs to be fully understood. But they have done some things where a lot of people in China are going to get hurt. Employees of Evergrand were told to they would lose their bonus if they couldn't contribute to some of the financial difficulties that the company has. They did a lot of wealth products there that people are expecting 13% returns. How's that going to play out? And so I do think it's much more internal than external in China. But I think the market is worried about contagion and what does this mean to the dollar? It strengthened yesterday. What does it mean to other emerging economies? And what does it mean when China's growth is going to be slowing at a time that the world needs pretty much everyone to be growing? So I do think we're in a wait and see mode. I don't think we really fully understand the interconnectivity the debt system in China, at least in the outside of China. I don't think it's well understood, and I certainly don't claim to understand it well. So it's hard to say what the ramifications of this for contagion would be at this time, but it feels like it's going to be more domestic than global.
Hey, Stephen.
Yes.
Thank you for the excellent Tuesday briefing. You
You're welcome.
closed with cautious but opportunistic. Always probably a good strategy. Is there anything special right now that would fit in that mold?
Yeah, I think, commodity related investments are getting knocked around pretty good right now. But I think you can look at them into different categories, like who are the ones that are going to drive the secular themes forward, which commodities are required for that, versus which ones are going to get taken out to the woodshed. The steel industry right now is under a lot of pressure when property development looks like it's going to be slowing in China. So what does that do to the steel market? And does it become pulled back enough that it creates big value, or what is it doing to iron ore and copper opportunities? So I think you want to look into your portfolio, see where you think the exposures are going to be impacted and not. But there'll be pullbacks and oversized pullbacks in certain areas that will create opportunities that you want to take advantage of. And I think that's going to come out in this. I wouldn't be rushing to buy some of the Evergrand properties unless you really knew what you were doing in that market and in those cities. But I do think you'll see some shifts in where investment capital goes. And I think this could have some short-term inflation implications as well. But it's going to really create some reallocation of asset allocation strategies for people where they had exposures. And I do think you might see some opportunities in the high yield area, which had gotten really has been very strong for a while. And maybe you'll have a little pullback, which will create some more opportunities for yield. So I think you just have to be really moving around. But I also think that we're going to have a lot of things coming up that are going to be volatile for the markets, whether it's the debt ceiling debate or whether it's just how do the Democrats resolve their internal problems before they take on the Republicans, which are going to give them no help. So it's coming at a time that will be unnerving for people, and we think that will strengthen the dollar and also attract capital to the U.S.
So I see Greg's got it.
Yeah, so the only thing I wanted to add is, I mean, I think the Evergrande explanation was on point, Stephen, and I agree on the contagion view that you have. This shouldn't be contagious, but the larger question is this: has the moment arrived when China has decided that the high targeted growth debt fueled model needs to be reined back? And if that is the case, then the implications for global growth are very large. And that doesn't play out overnight. That plays out over a protracted period of time when we start to understand what that means for copper, what that means for iron ore, what that means for inflation or deflation, right? My view is I think it's deflationary. And that plays into the temporary camp, but again, it's not overnight. So that I think that's where. And today I heard something very disturbing. I don't know if anybody caught Kyle Bass on CNBC this morning. He was talking about China, and obviously doing a victory lap because he doesn't like China. But one of the comments he made, which I haven't seen this, but I have to look into it, is because of these common prosperity directives that have come out, he said, I quote, companies will be contributing 50% of their profits after taxes to common prosperity. Now, if that's the case, then the whole sector everything's an SOE in China at this point, right? And I don't know whether that's true or not. I haven't seen that. That's a very strong statement, but I was a bit alarmed by it, and we'll be looking more into it or asking for color if anybody has heard something similar or has any views on that. But I think those are the two, especially the one where China has been an Asian tiger growth model
Mhm.
by several exponentially, right? And we all know how those things ended. They have a series of benefits, which is it's mostly financed internally rather than being financed externally. So you don't get to do a run on the bank like we did in 1998 with the so-called Asian flu. But yeah, so it's their election in general whether Evergrande becomes a Lehman moment or doesn't. They can keep prolonging this.
Is that, Greg, because everything's denominated in local currencies now?
Mostly, yeah. I mean, so you do have all these Evergrande dollar bonds out there, and they made it specifically clear, right, that people, those people will be suffering losses.
Yeah.
And that's just the way it is. Let me throw out a thesis here for everybody to think about eventually. Because there's a little bit of a dichotomy happening here, right? So in the past, I've spoken about the deliberateness of China in terms of how they want to insert themselves in the global economic order and the steps they've taken, right? And the lessons they learned from what they did in 2008, which was they carried the heavy burden of global stimuli in 2008. But the beneficiary of that was the United States. That's where the capital flowed, right? And then they ended up with the debt situation they have today, which in some respects is very similar to the debt situation they had in 1999. That led to the bailout of the 4 large banks through a very brutal financial repression, which made consumption to GDP go from somewhere in the high 30s, 40s down to arguably somewhere in the mid 20s. That's unseen anywhere in the world. That was a very, very high cost they paid. Over the ensuing 20 years, they've built the Chinese middle class. The Chinese middle class has been built on the back of property, in a way, as Stephen pointed out, right? The way to become middle class in China was to own property and benefit from the appreciation of that property. And some of the people who didn't have access to the property because of the crisis invested in wealth management products, which paid them pretty decent yields. Those two things are at the center of the problem right now. So when the time comes to assign the bill in China from this new debt excess, it's kind of clear to me that they don't want to assign it to the people again. And so what we're seeing here, and this whole regulatory crackdown, we're calling it a regulatory crackdown, but in reality, if Kyle Bass is right, and even if he's not right, even if it's not 50% and it's 10% or 15% that has to be going to common prosperity, that's wealth. That's a wealth redistribution exercise, and the bill coming due for the debt excesses. And this is all playing out right now. So I don't have a definite conclusion, but they've decided that they want it to be a force. They got themselves into the special drawing right calculation at the IMF. They got themselves a very high weighting in the MSCI emerging market equity indices, and they're getting themselves a high weighting in the world bond indices. This is coming up in October. The first leg of this this inflow into bond indices is starting in October. That's a little bit at odds with having an economic blow up right now. My thesis, really crazy out there. There's going to be one credit issuer in China, and that's going to be the Communist Party. That's who people will lend to, and that's how they will distribute them internally. That's my guess. This is a longer term, and just by judging by the things that I'm seeing right now, and that's what I wanted to leave everybody with.
Hey, Greg, that's a great point on whether China's, when.
I think we lost Stephen.
China really plans on slowing down the economy. Greg?
Yeah, I'm here. You cut off a little bit.
I'm sorry. I was asking about, they've been slowing down their growth since 17 or 18, haven't they? I mean,
They have.
By design. By
design, because it's unsustainable, right? Because the growth is debt fuel.
Right, but it's a planned effort to slow it down. So they're going to manage the slowdown from the government level. So the question really is, how do they deal with the excesses as they're managing the slowdown, right?
Yes.
Which that does push money into dollars and moves money into the US in our view, which I think makes sense. But I think you're right. That there is a slowdown. It's going to make China's not going to be the driving engine for the global economy, as they have been. But at number two, with even 4% growth or 3% growth, given the size of their economy, it's going to be pretty healthy growth for them. It'll be a little less for the rest of the world.
And that's the big issue, right? So
Right.
how much? So basically, in 99, 2000, when they recapped the big banks, that was their affair, right? They paid for it. The Chinese people paid for it. In 2021, my guess is they want to bail in the rest of the world in turn, which is basically what the U.S. did in 2008, right? In a way. And that's for me the lesson they learned from what happened in the global financial crisis. So there's a bail-in, there's a world bail-in going on, and they're engineering it.
Yeah, I agree. It's really interesting points. And yesterday there was a really good op-ed in the Wall Street Journal from the former Australian ambassador who talked about kind of the China political pivot, that's going on right now. And, I think that she has done an absolute masterful job of bringing China along and being able to now navigate the balance between giving the Chinese economy some rope to expand while still maintaining control. And clearly what's going on now and has been for a short period of time is that he's trying to lock down more levels of control in advance of the election coming up next year. So I think that he has just made this balancing act a lot more difficult. And if you think about it long term in terms of like the greater Chinese aspirations geopolitically, is that they continue to want to be like a major player on the stage, and they're not going to be able to do that without continued economic expansion. So right now he's throttling it back because of a political calculation, and that's somewhat short term because the election's coming up next year. So I think that it's going to be interesting to see how much throttling he's going to be willing to do. And you've already seen some of the impact of that already on the markets. And, this Evergrand situation only exacerbates that. And, when is he going to sort of ease up on the brake and at least, maybe tap the accelerator again? Don't know. But I think that's part of the dynamics, that are going on. Because clearly, in my mind, if China, and actually I think there was a headline maybe today in the journal that talked about China going back to a Maoist economic policy, that doesn't sound to me like it would be the vehicle to achieve their longer term strategic goals. Now, I could be wrong, but I think that we have a really delicate situation probably like over the next 18 months. And, we'll see, and there could be significant ramifications from that. We've already just seen one yesterday. So I don't know, we'll have to see, but I know that the people kind of on the ground, the entrepreneurs in China, have sort of been existing in a parallel universe, for a while. And we'll see if that parallel universe is going to be, continued to allow to exist.